What is up, everyone? Rob Sevilla here with Agape Insurance, and today I'm with retirement expert Mr. Jay Curatti, and we are going to talk about the best annuities for retirees that are entering into retirement and how you can use those annuities to create a guaranteed lifetime income and more. Jay, welcome to the Agape podcast.
Thank you, Rob. It's a great pleasure being here. Thanks for having me.
What I wanted to do today, Jay, is there are many people that we deal with in the Medicare space that have no idea what to do for retirement. They've heard of this word annuity, but some of them have heard maybe some bad things or not so good things. And so I really wanted to break down the 3 or 4 different types of annuities, what they're created for, and the best ones that retirees who are entering into Medicare can use to not only create a guaranteed lifetime income, but also protect themselves from any market risk. So let's start with the first one here on the screen, single premium immediate annuity, or we know it as SPIA. What does that mean? And is this possibly a good fit for someone who's going into retirement?
You know, it can be. It's one of these things that we have multiple opportunities. And in the past, annuity was just kind of a bad word in retirement. There were some really, really bad things out there, and people didn't know really what it was, and their money was tied up, and they didn't have access to it. A lot of variables. Carriers from that point to today have adjusted nicely. One of the nice things about a SPIA, and this is a little bit more of an old school one, but it's great when you would take a single premium, so you'd have a dive in with a certain amount of money that you would want to put in, and you want to start drawing money out immediately. So if we did something today, maybe next month on the 15th is when you're going to start drawing money. And that money, once it is there, it does give you that money every single month for the rest of your life. Now, we can do it for what's called period certain plus life. So there are a lot of ways that we can make this work beneficially for the customer. However, this is something where you put money in and you start getting money out within, say, 30 or 45 days after the account is written. So it can be, especially on those who might have a little bit smaller income from, say, Social Security, maybe not have any other streams of income. So yes, this is great in the right spot. This isn't for everybody, though.
Right. So just to clarify, this would be for somebody, like you said, who needs the immediate income to complement whatever their Social Security or whatever else they may be getting, just in case, that wasn't enough to maintain their current lifestyle.
Exactly. Not only that, but then it can carry on. So there's actually a case that we're working on currently for husband and wife. They're a little bit older. His concern is, because she's been a stay-at-home mom, how can we keep that money coming to her even if he would pass away?
Okay. So good. So the number 2 here on the screen, annuity, is a variable annuity, and you have an X through it, and says here needs a security license. So talk about a variable annuity and why it's probably not the best fit for people headed into retirement.
Yeah, that X is really important in that, Rob. It's something that it's out there, and it needs a security license, and we're licensed. We again have those similar licenses to other folks that write these variables. The issue is, though, with a variable is the very high cost of ownership, number one, the very high cost of internal fund fees, number 2, and number 3, it rides the stock market up and down. So if the market goes down, you're going to lose money and then have those fees on top of it. So if you lose 8% in the market, you might have another 2% you can lose as well. So for those folks in annuity, and again, in retirement, I should say, and from where I come from, I'm just not really sure it's really good for anybody, because it doesn't really do what an annuity should do, which is help safeguard some funds and provide income. It has a little bit more risk than we would like to see people involved in, and quite frankly has probably more risk than they should, more than just a little bit. It has a lot of opportunity for high expense, high fees, and volatility within the market, and that just doesn't seem to work well in retirement, which is why we put an X through it, because that's just not something we participate in.
Yeah, and I think that brings up a good point too, that if you're watching this today and you are in a variable annuity, this would be a good time to really review that with an expert like Jay and myself, or we could sit down, dissect that for you, show you a little bit better situation, especially if you're going into retirement, because Jay, you see this all the time. Of course, I hear this all the time. is that most people are scared. The number one fear is that they are going to run out of money, and have more life than money, so to speak, right?
Right. It is. That is. The survey was done by Harvard Business School, well, probably 3 years or so ago. And the question of retirees, those older than 65, is what's your greatest fear? And there's a big list of things to do. Death was on that. And they ended up saying, nope, I'm more afraid of running out of money than I am dying in retirement. So that's really important. And we just don't want to see that money slip away, especially if we're doing some withdrawals on the front end. We don't want things going out the back door, like fees and expenses that don't need to be there. That whittles down that nest egg, and that just doesn't seem to make sense.
Yeah, and you've seen this. I mean, this is what you're doing day in and day out. Obviously, I see it as well. Talk about the fees for a second, because I think there's so many people, or at least that I run into, that have no idea what type of fees are associated in these variable annuities as well as other fee type products.
Yeah, and that's a point that it's difficult to find. Typically, if you have a prospectus, you'll find this fee information on page 17 of 42 of the prospectus that you get, and nobody
Right.
reads that. They put it in the recycle pile or the fireplace or something just to move it along, and great, glad we have it, have no idea what it is. There's a lot of legal mumbo jumbo in there that needs to be there, but it's a little bit confusing. And so what we see there is there's just simply a cost of ownership, much like if you might be working with somebody. Again, I'm not throwing anybody under the bus, but some of the bigger names out there, there's what's called assets under management that you get charged for. So it could be 1%, 1.5%, 2%, whatever it is. It's the same thing with a variable annuity. It's just simply a cost of ownership. 1.3% isn't an uncommon number. There's a client that we've worked with who had significant amount of dollars invested in a variable annuity, and as we went through to scrub it and see where it was, he had this cost of ownership. He had internal fees. So there's a cost of whatever that variable annuity is invested in, like maybe some mutual funds you'd experience in the regular market. They have some expenses that are there. So those two numbers together came somewhere close to 2%. And he was just dumbfounded. He goes, I had no idea what was going on in there. Like most people, they don't. That if you really don't know what you're looking for, you don't know what you're seeing. And that's, again, no fault
Right.
of the consumer and no fault of anybody else. It just is. And so what's nice, though, is we're able to take these variable annuities, move them into a fixed index annuity, which we'll talk about how that works here in just a minute, without any cost, without any expense. There could be a little bit of a surrender fee, depending on how old it is. Most variable annuities are somewhere between 5 and 7 years old or long in length. And so depending on when we might move those, there might be what's called a surrender fee, but oftentimes we can make that up with a bonus on the other side to even get them further ahead of the game once we do that transition for them. So if you're in a variable annuity, it doesn't mean you're stuck in a variable annuity. There are options to move that out through some avenues that can be cleanly and easily exercised.
Yeah, and before we dive into the next two, I just want to encourage all of you that we offer an on-track retirement review that's at no cost to you, where we'll take a deep dive, look at what you have, once again, no cost, no obligation, to make sure that you are properly set up for retirement. And I can't encourage you enough that don't have a mindset in regards to your retirement that, well, if it's not broke, I'm not going to fix it. It's always worth having a second set of eyes. Your retirement's that important, and you want to make sure that not only do you have money to last you through your retirement, but I know many of you watching today want to leave a legacy for your loved ones. So let's dive into number 3, and that is a multi-year guarantee annuity, or MIGA for short. Talk about what that is and who that could be a perfect setup for.
This is a great way even to use maybe some synonymous on. If you think a CD for a minute at the bank, most people know what a CD is, and you take and you put some money, and it could be 6 months or a year or 2 years or 5 years, whatever that is, and you get a guaranteed amount of money that's coming back. Those rates have come down recently with the Feds changing their rates a little bit. But so it works similar to that in the fact that you put it in and you get a guaranteed rate that's coming back. Secondarily to a MIGA, what happens is when you invest the money, one of the biggest changes is you get typically a higher interest rate. Right now, we're seeing rates better than 5%, where CDs are 3.5% to 4%, somewhere in that world. Pardon me. And what happens there is when we invest money in a MIGA, we know that it's fixed year after year after year. Could be 2 years, could be up to 10 years. And it works well for those folks who say, I just want to make sure I'm getting some money out. It works, again, you may have heard of a fixed annuity, similarly to that, although the terms can be a little bit shorter. One thing that's different between a CD and a MIGA that's really interesting, in a CD, say you buy a 1-year CD and you buy it in May of the year and it doesn't mature until May the following year. Any interest you earn in the initial year, you actually pay income taxes on that interest in the calendar year it's earned. With a MIGA, it defers year after year after year. So that's what's really nice. And so you don't pay taxes on it until you withdraw those funds. On a CD as well, if you buy a 2-year CD, it is simply something that you might get 4.2% over the life of those 2 years. A MIGA is compounded. So if you're getting 5% just for easy math, you get 5% this year, and you're getting, say, a 4-year MIGA, you get 5% this year, 5% on top of it, the growth next year, 5% on the top of the 2-year growth third year, and 5% on the 3-year growth on it. So it's compounded in that interest table. So the likelihood of making significantly more money in a MIGA over CD is very, very real.
Yeah, and I want to encourage all of you that are watching this today, if you have some CDs in specific banks, it's not necessarily a bad thing, but really you are costing yourself long-term money with that compound interest. And once again, we would be more than happy to review that for you at no cost, no obligation to you. You can book a free consultation down in the video description below, and myself and Jay would be more than happy to connect with you. Just like I said, give you that second set of eyes and make sure that you are prepared. So let's talk about the fourth and final one, and that is a fixed indexed annuity. What is that, and who is a good fit to maybe roll their money over into one of these?
Yeah, I think that the vast majority of people would fit well into this category. The nice thing about a fixed index annuity is if we break down that word, we have fixed and we have indexed. So fixed means there's a floor. There's a certain amount that you won't lose, which is zero. You just don't lose any money in this. So I'll explain maybe a little bit more here in a minute what that actually looks like. But if the market goes down, much like in a variable annuity where you would lose your money, you don't lose money in a fixed index annuity. The indexed part is that when we go ahead and we attach it to an indexed account for accumulation. So
Right.
there are two different ways with a fixed index annuity. One is for growth and accumulation. One is also for income. So much like we do with a SPIA, we might buy a fixed index annuity and say, yeah, we want to turn some income stream on. Say we want to buy it at 62, but we're going to work until we're 67. So let's let this thing grow for 5 years. And at 67, we're going to start pulling some income out of this. And that money can go on and come into the household for as long as there's breath in our lungs. So that's the income idea. The other side would be growth. And that growth side or accumulation is we're going to put it and we're going to let it grow. We're going to have it grow year after year after year, not losing any money. So if the market goes down, why, we may not make any money, but we didn't lose any money. And for those in retirement, that is of paramount importance. We need to go to bed at night when the market's down 600 points and go, didn't affect me. And you rest well, you sleep well, because you know that it's annualized as far as the growth is concerned. It's not something that, again, rides the roller coaster of what a variable annuity or what the stock market does. So a fabulous, fabulous investment tool for those people in retirement.
Yeah, and let's stay there just for a second, Jay, because there's a lot of people that I run into when I'm doing Medicare reviews with them that they just do what everybody else does, and they just keep it in their company 401k or 403b or pension. Can you talk about maybe some cons to that, some negatives to that, and why it's important to at least review that and see how maybe a fixed index annuity could be a better solution?
Absolutely. Yeah. One of the things I think people aren't really as aware of as they may think is they are leaving money in a 401k. Say you're 61 years old, you're thinking about retirement. You go, well, I've got all this money in my 401k and it's a significant amount of money. Once you're past 59 and a half, there's the opportunity, what's called an in-service rollover. So literally those funds that are in your 401k can be rolled over into some of these other accounts and make it look a little bit more growth opportunity versus sitting in maybe these 12 mutual funds A, that have high expenses to them, and B, you don't have that much control over. Those are the options. There are 20,000 mutual funds out there, but we have the opportunity in 401ks or 403bs, 457s to say, okay, I've got a question or an opportunity of these 15, 2 in each different category. And that's what, so we're able to move those out. If you've separated from the company and the money is still there in the 401k, rolling it over into some of these annuities make a lot of sense because, again, you're not riding the roller coaster of the market, and you have more upside potential with zero downside liability.
Yeah, and when you mean zero downside, what you're basically saying is that they can't lose, right? So even if there is, like you talked about a few minutes ago, even if there's a downturn in the market, because these aren't directly tied to the market, they don't lose anything that they've earned or the money plus the money they put in.
Correct. What happens in that process is if we take money, say there's a fixed amount, say $100,000 that we might put into this account. And you can see on the screen there that let's say on February 1st of 2024, we go and we tie it to the S&P 500. And the S&P 500 is the Standard & Poor's 500, which is just the 500 largest publicly traded companies in America. So as we tie it to that, let's say in February 1st of 2024, it closed, which is an actual number at 4906.19. And then nothing happens in the year. So again, we don't have to worry about up market, down market. On February 1st, on the anniversary date, we look at it. So February 1st of 2025, this year, we'll look and say, okay, if the market's down to 4,200 and a 14% loss, what happens is you didn't lose 14%. Think back to 2007 when you lost 40% of your income or of your savings. What happens here is you don't go down 14.39%. You're at zero. So you didn't make any money, but your 100,000 is safe and you don't lose a dime in that process. So it is so important to realize consumers can track it. They can see what the S&P does and kind of go, okay, well, it went down. I didn't lose. Conversely, if we look at the market and now we have to have some upside growth. Now there's a cap on that because we're not assuming any liability on the downside. We can't get everything on the upside. That would be the greatest investment ever.
Right.
And everybody wants that, right? So there has to be a cap there because the carrier, the company, is assuming your liability for the downside. So anything above, say, that 10%, that would obviously be there. And that's how they're able to fund the fact that you don't lose money and keep their policies and their liquidity in their company working well. So using those same numbers, 4906.19, 2001 of 2025, it's at 6,040. Now, we've had a 23% growth. Now, we didn't get 23%, but we got 10. So that $100,000 is now credited as $110,000, and now that's the safe number. So in the next year, up to February 1st of 2026, the market can take a dive if that's what takes place, or maybe even the third year or fourth year. There's an inevitable correction that takes place. Whatever that number is safe. It won't go below where you are on that anniversary date. So again, say the market only would grow 7% in 1 year. Well, because you have a cap of 10%, why you'd get that fullness of that 7%, and that 100,000 would get $7,000 added to it. So it's kind of the tortoise and hare understanding. We might make a lot of money in the market 1 year and then all of a sudden have it lose a bunch of money on the 30th of December and it wipes it out. This is the tortoise. It's slow and steady. It makes sense. We've got upside potential. We mitigate the downside liability, and it just makes sense so that we can have peace when we put our head on our pillow at night wondering what our money looks like.
Absolutely. And as we get ready to close today, Jay, talk about how powerful this graph is. And if you don't mind just taking a few minutes to explain, because I think this is very powerful because there is a lot of misconceptions about annuities out there, or people just don't know what they know. Can you just break this down for us as we close today?
I can, thank you. This is important. The red line that you're looking at, that's the S&P 500. So this is actual money dating back to 1998 with $100,000 invested in the market. The green line is a fixed index annuity with a 10% cap. The blue line is just a 4% fixed annuity. So again, you can see just a very steady 4% growth. And the yellow line is another, not really germane to this conversation. But we can see back in 1998 with that 100,000 invested, there's a little bit of growth. And then that first slide you see, that's the dot-com bubble we saw in 2000. And then we have a little bit of growth from that. And then where the arrow is, we see That's the market crash we saw in 2007, 2008. The fixed index annuity had grown to about $155,000 at that particular point. You can see that the red line goes down and the green line is flat. You didn't make any money that year, but you didn't lose 42% like your neighbors did either. So that's significantly important to see where that is. And then as we continue to go along the green line, you see other flat points. Those are what we call stair steps. And so if the market goes back by $3 as it did one year, you didn't lose any in your annuity. If it goes back significantly, like we see at the V cut toward the end there, lost all that money in 2021, the fact that it came back in 2023 is remarkable. This growth since 2008 is unprecedented in the history of the market. The neat thing is those stair steps along the way, every time the S&P 500 went back or was flat, you didn't lose any money either. To the point at the end of 25 years, the fixed index annuity with that 10% cap outperforms the S&P 500 by $50,000.
Wow. That's
real money.
Amazing. Yeah. And a lot of people, like I said, just don't know what they don't know. And so, part of what we do is we love educating people and making them aware of this, because a lot of them don't know the fees that they're paying. A lot of them just, don't understand really the investments they're in. And when we educate them and really dissect that for them, it's very eye-opening when you sit down with people for the first time and go, I really had no idea, because you hear that pretty commonly, right?
Dude, one of the hardest things in the world to know is what you don't know. If we knew that, we'd know everything. And that's just not the case. So we don't know what we don't know. And oftentimes we hear from maybe some financial advisors, some people in that world that have helped them in the accumulation process. That's great. But now that we're on the distribution side, just wait is not a very good strategy, in my opinion.
Right.
It's something that just waiting to see what it looks like and wait and see what the market does, and we'll recover. One thing people don't have who are near or in retirement with their investments in the compound interest table is time. And we can't recover like we did 17 years ago. If you're 65, 67, 70, 72 years old, whatever that may be, and you take a significant hit in the market, we don't have time to recoup those funds, number one. Number two, what does that devastation do to our nest egg at that particular point? So not saying that we should never be in the market. There's a certain amount that should be, but the stuff that we need to keep safe, the dollars we need to keep safe, we need to have that in a way that we can rest comfortably knowing, golly, I'm just not going to lose any money at this point, but I still have upside potential.
Right. Absolutely. Well, Jay, thank you so much for giving us that explanation of those 4 different types of annuities. And there's so many other things that we could cover, but if there's something that we didn't cover today, or you have questions that maybe have arose from this conversation, put them down in the comment section below. And I promise that myself or Jay will answer those questions for you. And as we close, I just want to give you a reminder. We give a complimentary on-track retirement review. You can see here on the screen that we are going to go over 6 elements that we believe that need to be in place in order for you to have a solid and happy retirement. And you can simply book that by going in the video description below. I'll also put my website here on the screen. You're more than welcome to go there, and you can click on the button that says, hey, contact us, and myself or one of our advisors will get back with you. And I can't stress this enough. This is at no cost or no obligation to you. And as you see here on the screen, what if 60 minutes could literally change everything for you in retirement? It's literally that important. Jay, any parting words as we close today?
From that review, something that's so important, maybe something that takes it down to where I think we live on a regular basis. You're having knee pain and you go to your doctor and they says, I think we need to replace your knee. Chances are great. Most people go, can I get another opinion? Whatever that looks like, this call that you're talking about, Rob, is nothing more than a second opinion. Let's see what it is. We may have some great strategies for you. You may be in a great place. We don't know until we look at it. Chances are great we might be able to help you in some of these areas to help your retirement have a little bit more security, a little bit more confidence, a little bit more peace of mind. And that's a big price tag on peace of mind nowadays.
Yes. And there really is no price on peace of mind for sure, right? So like Jay said, if you just needed a second set of eyes, maybe you feel like you're good, but it never hurts to get a second set of eyes, a second set of opinions, if you will, on your retirement. It's literally that important. Well, Jay, thank you for spending a few minutes with us today, giving us some valuable information. Please take a moment to like, comment, subscribe. This just helps us get this more information out to other retirees like yourself. And by the way, if you are going to be new to Medicare this year in 2025, go check out my brand new Medicare 101 webinar with 2025 updates here.